which one is the best one for you. If you are joining us for the first time, welcome. Remember to post your questions in the Q&A box on the bottom of your screen. And if you missed yesterday's episode, it is available on our YouTube channel, and so will this one. So without wasting any further time, I will hand over to Craig. Also, I forgot to tell you who I am if you are joining us today for the first time. I am Bonolo Medise, and I am the newest member at EasyWTF, and we are joined by Craig, who's also a member at Team Easy, but also one of the country's top 3 financial planners. So we are really, really delighted to have Craig to educate us and give us more insight on retirement annuities. So before I hand over to Craig, I just want to ask Craig a question. So Craig, you mentioned yesterday briefly on tax-free savings versus retirement annuities. So what are the differences, or are they, I know that they both have tax benefits, right? But can we just get a brief overview of the two?
Okay. Morning, Bonolo. Hope you're keeping warm today. It's a little bit fresh outside, hey? Cool. But do you want me to just to go through perhaps the the subtle differences between an RA and a tax-free savings account?
Yes, please.
Okay. All right. Cool. Okay. So if we start with perhaps the contribution limit, so both of them do have limits in terms of how much you can contribute over a year, over a tax year. So with the retirement annuity, I think like we touched on yesterday, the limit is 27.5% of your gross income, so your income before tax. All right. And that is capped for the very big earners at 350,000 Rand a year. So, so SARS has put a restriction on the contribution limit there. And then on the tax-free savings account, you've got it's now 36,000 Rand a year. This year they did up it to 36,000 Rand a year, which is really cool. And they've also set a limit of 500,000 Rand over your lifetime. So as you contribute, as you've reached, it's probably going to take you about 15 to 17 years to get to that contribution threshold of the 500,000 Rand. And at that point, you're not going to be able to contribute to a tax-free savings account any longer. So let's hope that, Treasury and they do, increase those amounts over time as well. Then, but not if we look at withdrawals, withdrawal, can I pretty much access the investment whenever I want to? So tax-free savings, yes, of course you can. The interesting part there is that if you have contributed your full 36,000 Rand for the year and you make a withdrawal, you can't put it in again. So investors must just be aware of that. And then with the retirement, so that's with the tax-free savings account, and then with the retirement annuity, as we touched on yesterday, you can only access the money when you get to your vintage age of 55. So that is the minimum age in a retirement annuity. I think the next best thing is diversification, which is pretty much the how you can invest within the retirement annuity and how you can invest in your tax-free savings account. So with the retirement annuity, because it's governed by the Pension Funds Act, the asset managers have to stick to what's called Regulation 28 constraints, which is how much exposure or how much you can invest in an asset class. So an asset class could be equities, it could be property, it could be cash, offshore, local. So there are guidelines and restrictions in place in a retirement annuity as to how much you can. So for example, you can only invest 75% your investment in a share, in an equity within a retirement annuity. So the reason why they've done that is to protect people from investing in something which is, too risky. So, so people do see there's pros and cons to that, because some people believe that they would like to invest, more aggressively in their retirement annuity, but the Regulation 28 does restrict them. And then also in that Regulation 28, you can only invest 30% of it offshore. So again, is it a good thing? Is it a bad thing? But within a retirement annuity, we have to stick to those regulations. So in comparison to that, a tax-free savings account, there's no limits. There's no restrictions. So you can invest 100% offshore, for example. You can invest 100% in equities if you'd like to. So there really is no limits when it comes to fund choice in a tax-free savings account. Another investment difference is in the markets and in our fund managers, we've got what's called a performance fee. So some asset managers charge performance fees. So if they get a good return, above benchmark return, then they charge an extra few basis points on top of what they normally charge because of that overperformance. So their performance fees are allowed in the retirement annuity, but in a tax-free savings account, the rules say that you're not allowed to invest in anything that has performance fees. And the reason why they've done that is to really, again, protect the investor and keep the costs as low as possible within a tax-free savings account environment. The next one, can we invest for minors? Can a minor invest in a retirement annuity? Yes, they can. Can a minor invest in a tax-free savings? Yes, definitely. With the retirement annuity, obviously the restriction is they can only access it when they're 55. So they're going to be really, really long-term investors. Whereas with the tax-free savings account, they're going to be able to access that, on approval of the guardian, the parents, or whoever started the investment for them. And then the last one, Bernardo, is it protected from creditors? Like we spoke about yesterday. So a retirement annuity is protected if you do owe people money, which is quite big if you think about an entrepreneur, business owner in high-risk environments. And then a tax-free savings account isn't protected, so they would be able to attach that. Yeah. So I think those are some high-level stuff, Bernardo.
Yeah, it certainly sounds like it's high level. So under what circumstances would I pick a retirement annuity versus a tax-free savings account?
Cool, yeah. So I think it's a great question, Bernardo, because I think it's very much dependent on your portfolio, on what your investment portfolio looks like at the moment, if I can say that. But some tips on why an RA is, the first one is that you get the tax deduction on your contribution in a retirement annuity. So what that means is it essentially lowers the amount of tax that you pay every year. So if you, let's say you fall in the 25% tax bracket, so every month or every year you pay 25% tax on your salary. If you're contributing to your RA and sticking to those limits that we spoke about earlier, the 27.5% limits, if you stick within those limits, whatever you contribute to your retirement annuity, SARS is going to give you 25% of that back. So if you're a 30% taxpayer, then SARS is going to give you 30% back of whatever your contributions are. So a cool way to look at that is if you had to take what SARS gives you as a refund because of your contributions to your RA, and you add that back into your RA, you're getting a 25-30% return on your investment every single year. So that's one way to look at the benefits of an RA versus a tax-free savings account. I think the other thing is it's purely retirement focused. So in our business, we've seen about just this year, about 10% of the income that has come into a tax-free savings account move out. So people have invested, but then 10% of them have withdrawn their money from their tax-free savings account. So those people who were using their money, using their tax-free savings account for retirement, then they're going to become a little bit unstuck, a little bit down the line, because now they're accessing the money that should have been there for, for retirement, for their vintage years. So it's retirement is purely for retirement, and it needs to be seen as that. And I think it's a benefit that you can't touch it. The next one is, if you feel like you're not a disciplined saver, that you invest, but you withdraw and you change your mind all the time, and you like to spend, rather than save, which a lot of South Africans, as we know, are, then a retirement annuity is a good one for you, because, it protects you from yourself, essentially. And then, like we just spoke about just now, it protects you against creditors. It really it ring fences your money for when if something ever does go wrong down the line, which I think is a big benefit. Yeah.
Thank you so much for that. Which investment vehicle would be best suited, say, for a self-employed person, a person that is employed full-time, a person that's about to retire, and a student?
Sure. Cool. All very good questions again. Okay, so I think I would say, so start with your first one, a self-employed person. I think a retirement annuity is going to be the better one, because they wouldn't have a pension or provident fund that they're contributing towards. And then being a business owner, self-employed, there are risks associated with that. So when you do go into business and on your own, you've got to be aware of those risks. And yeah, so the retirement annuity is the way of protecting, your future and some assets down the line. So self-employed, I'd go RA first, but then there's no reason why, if he's reached the limit in his RA, why he shouldn't be contributing to a tax-free savings account at the same time. So like we said yesterday, they work very well in conjunction with each other. But in this case, I would say put the RA as priority above the tax-free savings account. An employed person. So an employed person, let's say they do have a pension and provident fund, Bonolo, then I would say they're contributing to retirement. Then I would look at the tax-free savings account first. And then once they've exceeded their tax-free savings account contributions, and if they do have more to invest, then possibly look at first topping up their pension and provident fund, if they wanted to. And then they could also top up their RA, at the same time. So employed person, I'd say tax-free trumps retirement annuity if they are contributing to some sort of retirement vehicle. Then I think you said student. So student, definitely tax-free savings account. Get them investing, get them used to investing, get them used to the fact that there's a debit order coming off of their account. And, once they start earning a salary, that salary just isn't going, straight into expenses and lifestyle. They get into that routine of putting money away. So I'd say a tax-free savings account there. And then your last one, Panola, was it retirement, close to retirement?
Yes.
Yeah, so close to retirement is an interesting one. There, I would say probably both, but I think somebody who's close to retirement would have to look at what we call their liquidity scenario. So liquidity is how much cash do they have moving towards retirement, because that cash is essentially going to pay for lump sum expenses. So it's going to pay for holidays. It might have to pay for some new cars. It might have to pay for some debt when you get into retirement, because when you get into retirement, you really want to make sure that you're debt free. So if you analyze your liquidity and you say, okay, well, I'm a little bit light on liquidity, then probably a tax-free savings account is the best way to go, because you can access all of it at any time. But if liquidity is fine and you've got tax-frees going and you might have a share portfolio, you might have some unit trusts, so liquidity isn't an issue, then maybe an RA is still a good way to go, because you're getting the tax deduction on the contribution, you're ring fencing it, and that retirement annuity is going to be able to provide you with income. So it's a balance when you're moving towards retirement. It's that balance between how much of my investments are going to be giving me income versus how much of it do I need in order to provide for my, let's call them capital expenses. So capital expenses like the cars, the holidays, debt, all those sort of things. So close to retirement, I'd say they're both good. To just be dependent on your situation that you're in right now.
Awesome. So as you know, at Easy, we have a split of 7-3 of men who have invested to women who have invested, because industry norms say women are more risk adverse, so are bound to invest into RAs. So do you think that the stats hold true for us at Easy?
Yeah, it's a very interesting one, Bonolo. I think, I mean, I would say that there ideally there should be no difference between how a woman invests versus how a man invests, if that's what the stat is showing. I think if a woman is perceived to be, more conservative, I'd say that we need to do maybe just some webinars, or some add to our frequently asked questions on our platform, because essentially the way that you invest should predominantly be made around the intention of the investment. So whether you're male or female, if the intention of the investment is to invest for retirement, you should be investing the same way. So if it's retirement, you should be focused more on growth assets like equities and property and stuff that's going to give you good growth over the long term. And that's no different between a man or a woman, essentially. It just comes down to the reason for the investment and the intention for the investment. If you'd like to build up an emergency fund and say, well, I might need a couple of months worth of expenses for some reason. Maybe I'm changing jobs in a couple of months, and I don't know if I have a job, so I need to build up some cash, or I want to build up some cash for an emergency, like an appliance breaking down or my car breaking down or something like that. Then whether you're a man or a woman, you should be in a conservative cash type strategy, because there you don't want risk, there you don't want volatility. So you just want to keep that in an account, in a bank account that's easy accessible, and you can get the money on the same day. So I'd encourage men and women to be investing the same way, and to rather focus on the intention around the investment. If a woman is perceived to be maybe slightly more conservative, maybe it's in their nature, but it's just worthwhile going through and just understanding what the intention of the investment is.
Thank you. So there are very few RAs on Easy, as you know. So do you think we anticipate more to come?
Sure, I'm super excited about that question. So we've got our retirement annuity structures called the EasyWTF Retirement Annuity, and it's done amazingly well over the years. Some comments that we've had from clients is that we don't have enough fund selection within our retirement annuity. So when they open up their retirement annuity account, they have to choose which fund managers they're going to invest on. And at the moment, we've got 4 fund managers that they can choose from. So from July this year, we're going to be adding on another 8 different asset managers, which is really, really exciting. There's going to be some big names in there, some household names. So, and each one of those asset managers, we're going to have probably 3 or 4 different funds from each one of those. So we're going to have a lot more variety. It's going to be a lot more sexy. And I just like to remind everyone on the webinar here as well that if you do have other retirement annuities out there that are high cost or they're non-performing, we have a very, very robust system of moving those bad RAs into our RA. We just take care of the whole process for you. So we take the admin away, and we'll get it onto our platform, and we'll get it onto your EasyWTF account in a very short turnaround time. So very, very exciting times. But just to add on to that, if there are questions, over and above the webinar or the questions we're going to take today, we do have an amazing FAQ section, on the platform around retirement annuities, around all our investments. So if clients can just refer to those, and we've got amazing blogs, which is going to detail and outline all these things at the same time. So if the listeners and the viewers can look out for that, and our new trust managers in July, I'm super excited about that.
Certainly. I think we can dive into some of the questions that our viewers are asking.
Awesome.
I'm going to open Leslie's question. Leslie says, we mentioned that an RA has some sort of tax relief whilst employed or working. Won't I get tax in the future, say after age 55, when I have access to my money? When I have access to my money from an RA, is the tax relief whilst working not a mere delay of tax for a later date post age 55?
So it is perceived as a delayed tax. I think the big thing there is the deduction on your contributions while you're still working. That's over and above the growth in the retirement annuity being tax-free over a period of time. So it is delayed to a certain extent, the growth of it. But then in retirement, you then have the choice of taking some of it out in cash. So you've got 500,000 Rand that you can take out tax-free, which is really, really nice benefit. And then the tax that you pay in retirement is dependent on how much you are withdrawing every month. So you can calculate the different tax rates that you would pay in retirement and make sure that you're paying less tax at the time. So while you are working, you're probably going to be paying more tax, while you're earning a salary. Then when you get into retirement, you're going to be drawing down from your retirement annuity. So you're going to fall in a lower tax bracket, which helps. So you are going to pay tax in retirement, but it is going to be less. So I wouldn't let that, stop me from investing in a retirement annuity over a long period of time.
Now, Craig, I know you touched on withdrawals and so forth. Now, Zetu wants to know, does South Africa place penalties for those who withdraw from their RAs before their retirement age? Because he mentioned that he's fighting his mother as she wants to withdraw hers to pay off her debt.
And then she would pay a penalty on that.
Yeah. Would she pay a penalty for withdrawing from her RA?
Yeah, so we touched on it a little bit yesterday, where so that penalty would be dependent on where and who you took out the retirement annuity with. So if you took it out through an insurance company, and the broker, if there was a broker involved who sold you that policy, normally a commission is paid, and they're paid up front. So then the rules of that retirement annuity are, if you do withdraw before the age of 65, generally, then you're going to pay a penalty on it. But if you did take it out, or you did move it to something like an EasyWTF RA, there's no penalty to withdraw. If you did use it, so it's definitely worthwhile investing. So my suggestion to him would be, find out from the insurance company what that penalty is. If it's a sizable penalty, weigh up what is the debt costing me versus what the penalty is costing me, and take it from there. And then don't just withdraw from the retirement annuity to pay off debt. I mean, you know, does her mom have money for the rest of her life, you know, to live off? So, so before just paying the debt, you know, make sure that, you know, there's other expenses that can be covered as well through retirement.
And I think I came across another interesting question from Nick. Nick says, for an employed person with no contributions to any fund, should that individual contribute the 27.5% of their gross income? Would they then be able to claim that 27.5% from tax, as they will be contributing a net figure?
Yeah. So if he's not contributing to any other retirement fund, he can contribute 27.5% to his retirement annuity, you know, every year and get that deduction back. Yeah. So he can do that. And yeah, he'll get the full deduction back from SARS at that 27.5%, which is really cool. Bearing in mind, you know, that 350,000 Rand a year cap. So he must just make sure that he's not reaching that cap if it's applicable.
And I've been seeing a few questions about migration. Nick also wants to know, could you please just clarify on taking money out of your RA should you migrate financially?
Yeah, cool, good question. So if you before the age of 55, okay, and you're looking to immigrate, then you would have to formally financially immigrate. So, you know, that essentially means that you remove yourself from being a tax citizen from South Africa. So as soon as you do that, then you can access the money from your retirement annuity. You can get it paid out in cash. You're going to pay tax on it, but at that point you will be able to get the money out. So it is a bit of a process. I mean, it's just warning everyone. If you do go through that process, it probably takes 4 to 6 months to, once you've, you know, financially immigrated, to get the money out. So it is a bit of a process, but you will have access to your money, no problem at all.
And we have our regular and enthusiastic Heno, who's 15. I think who missed us yesterday. I think he wants to know at what age would we recommend that he starts put money away in his RA account.
Sure. So if he's 15 and he's listening, he's obviously got a tax-free savings account already. I won't question that. I would say, Heno, as soon as you get your first paycheck, as soon as you get your first salary, then it's a good time to kick off your retirement annuity journey and get that tax deduction and start saving for, you know, when you get, you know, close to my age of 55, eh?
I'm sure Heno is pleased to hear that. I think we are going to wrap it up. Craig, thank you again for joining us this morning and for educating us on tax-free savings versus retirement annuities.
Absolute pleasure.
If you've just joined us or missed this and yesterday's episode, they are available on our YouTube channel, and we will be sure to answer the questions that we have not answered on this morning's series. So from me to you and Craig, have a lovely day, everyone, and thank you so much for joining us. See you tomorrow.
You too, Bruno. Cheers.
Cheers.
Bye.
Bye.
Nice, bright color. It's a fantastic day. It's a good day to be alive. Come to think of it, every day's a good day to be alive.